My portfolio for this channel just hit some major milestones, with one biotech stock absolutely crushing it at 27% gains, but also sitting on some positions that need some serious attention. Today I'm giving you complete transparency into this channel's portfolio, every single holding, the winners, the losers, and 3 major changes I'm making right now for Q4 2025. Welcome back to StockScope Live. Today we're going to do a special type of episode, the first of its kind for this channel. We're giving you the complete overview of the channel's portfolio. No fluff, no fake numbers, just real holdings, real performances, and real decisions we're making with our own money. Before we dive in, I'm going to give you a quick overview of this portfolio for the channel. The total portfolio sits around 5,500 Canadian dollars and is split across 2 accounts. There's 19 holdings and they're stretched across different sectors. Some of the stocks that we have in here are MDXH, which is up 27%, and a bunch of other ones that are up just around that amount. But stick around to the end of the video because I'm going to talk about 2 stocks that we sold. One of them crashed after we sold, and the other one had a little bit of upside. We'll talk about the benefits and the timing strategy that we used. And so I think that will be beneficial for anybody who's new to trading and would like to see a real-world example. Stick around. Let's get right into it. We're going to talk about 4 different key points, and we're going to go into details so that you can understand how we're thinking when we're making these decisions. Right now, we're only going to focus on the position returns, and then we're going to discuss the sizing of the positions. We'll start with the one that's absolutely killing it, MDXH, and that's the molecular diagnostic play. It's leading the charge at around 27.7% gains. The stock is near the top of its 52-week range. It's also above its 200-day moving average. The revenue growing is about 28% year over year for this stock, right around 90 million. Now, why is this stock working? Well, the molecular diagnostic market is exploding as precision medicine becomes mainstream. They're commercializing cancer diagnostic products and institutional money has been flowing in. Now, there is a company, an investment company called AWM, and they've increased their stake in this company by a whopping 10.6% last quarter. Now, the health sector rotation is happening right now, and the position is perfectly timed to actually take advantage. The second one on the list, as you can see, is Micron Technology. Now, this version of the stock is the Canadian hedged stock because I live in Canada and this portfolio is a Canadian portfolio. Now, as we know, the memory semiconductor space is benefiting from AI infrastructure buildouts and data center demand. And instead of putting money in this portfolio into NVIDIA or AMD or any of those guys, we're going to invest in Micron, which is going to benefit from anyone building a data center. And so you're going to see how this position is actually going to be working well into 2026. And we knew that it was going to do really well with the super cycle timing of 2025. The third best performer is Navitas. This is a nanotechnology play. And as you can see, it's up around close to 21%. It's a small position, but that's because it's risky. And it shows how technology convergence themes are still working if you're picking the right name. Now, the next one is really interesting, and I picked it specifically because I wanted to prove that when you pick something like MDA, the aerospace and defense contractor in Canada, being one of the only profitable companies and having government contracts, you're bound to win. As you can see, it's up almost 15%, and because defense spending is going strong and their order book continues to grow. Sometimes people forget overvalued companies with little to no revenue doesn't make sense and the risk is too high. Finally, you're going to see that the largest holding here is XGD. And XGD is the BlackRock Canadian iShares that is gold miners, large gold miners. And as gold keeps going up, and I'm expecting it to continue to go up, this is a safe bet. It's up about 10%, and it represents 29% of the portfolio. Now, this is only a temporary measure because we know that gold's going up. In a normal stance where gold wasn't going up this high, this position would likely be only 15%. Now, let's get into point number 2, the uranium and resource positions. They make up a significant portion of this portfolio. I have 3 uranium positions: Cameco, Dennis Mines, and Next Gen Energy. All of them are doing okay right now. They're fairly new to this portfolio, so we're not going to focus too much about their returns just yet. My take on uranium right now is the fundamental thesis remains intact. Nuclear power is experiencing a renaissance, and data centers driving new demand, and countries are recommitting to nuclear energy for carbon reduction. Cameco is the industry giant. It's ramping up production at the McArthur River after years of care and maintenance. The challenge is timing, because uranium prices are obviously volatile, and these stock moves with that commodity. But I'm holding because supply-demand dynamics haven't changed. There's still a structural deficit, and these companies control the highest grade deposits globally. Now, my gold mining exposure beyond XGD includes Kilo. As you can see, it's the second largest position. It's got a solid 5.04% gain because Kilo is actually a gold bullion fund that tracks physical gold. And this provides pure precious metal exposure without mining operational risk. Then there's GORO, which is also a large position. It's very new. It's only been there for a few days. It's a gold road resource. And while gold prices are strong, operational execution matters in mining. This position size is sized appropriately as a higher risk play. But it's also part of some of very, very large ETFs. One of the things that we do is we verify where big money is playing. And we notice that GORO is one of those companies that big ETFs are also betting on. And so we've made our own play. The energy sector rounds out the resource exposure with CNQ. Now, it's a very small position, but we wanted to track that as part of our portfolio. It's nearly 4% gains. Now, FAT is Foremost Clean Energy. Very new position as well, and it's gaining over 2% right now. Well, the energy has been surprisingly resilient, and Canadian energy companies specifically have shown very strong cash flow generation. So we're going to continue with point number 3, the underperformers and the portfolio issues. For the positions that need honest evaluation, some would say QQQ right at the bottom of this list, and for some reason it's not showing. We're going to try to make it work. We're going to actually just click on it. And as you can see with QQQ, we bought 1,000 shares at 21 cents Canadian, and we're down about 12%. It has a drag on performance as technology valuations have compressed. But I'm betting big on this for the long term. I'm waiting for some of the timings that are coming up for some catalysts like their surveys. And so 1,000 shares at 180 Canadian dollars it's a very small percentage of the portfolio that I'm willing to gamble on some large and larger gains in the next 12 months. The position issue is it doesn't align overall with my overall strategy for this portfolio, but I honestly not really going to care about it because it's such a small position. Bristol Myers Squibb is down about 4.5%. It represents the large cap pharmaceutical exposure. BMY has been struggling with patent cliffs and competitive pressure, but they're investing heavily in immunology and oncology. The dividends yield is attractive, but the growth story still needs some work. And we're saying that, hey, we think that they're going to overcome that. But this is a great example of how things can lag when patents and other government regulations stand in the way. The next one that we want to talk about is ABUS. This one is down about close to 6%, but it's a speculative biotech play. Very small, 18 shares, and it's appropriately sized. Biotech is notoriously volatile around clinical trial results as well. So we're going to see what happens. The next one I want to talk about is Westbridge Renewables. And Westbridge Renewable Energy is a Canadian energy company. It's very unique. It might be down right now about 2%, but it's actually one of my more interesting positions, and it deserves a deeper analysis. It's a Canadian renewable energy company focused on utility scale solar projects and battery energy storage systems. They're working across Canada, the US, the UK, and Italy. Here's what makes Web compelling. They just announced a significant 20 cents Canadian special dividend payable on October 17th. And that's on top of their previous 10 cents dividend return from June 2024. Now, for a company that's trading around $3.08, this represents substantial shareholder returns. Imagine if you had a much larger position. They have over 3.5 gigawatt of completed development projects and also a 10 gigawatt pipeline equivalent to powering 580-ish thousand homes. But here's the challenge. The renewable energy sector has been volatile. Web is down about 8% over the past year, despite strong fundamentals. But most companies with strong fundamentals don't see a massive correction when the market corrects. The company is expanding into data center projects in the US, and that's going to provide exposure to AI infrastructure demand. And execution risk remains high in development stage renewable projects, but I think these guys have proven themselves to be reliable. Here's what bothers me though. There's a huge concentration in this portfolio in XGD, which is a single ETF. But risk management says I should trim the position and diversify into other positions. How do I make sure that I don't lose that money? Well, that's where sell orders come into play. We got to make sure we have our sell orders in place so we do not lose money when the market tries to correct itself. And we can always buy back in because ETFs don't move that fast on day-to-day changes. Key point number 4, the portfolio changes that we're going to try to make for Q4. Change number 1, we're going to trim XGD position from 29% down to 20%. This means selling about $400 to $500 worth and redeploying it into either individual gold miners or other sectors. The position has worked, but concentration risk is real. Change number 2, we could exit QQQ entirely, but we're not going to do that just yet. We're going to wait for the catalysts, and then if we see massive profits taking or massive gains, we're going to take some profits. Change number 3 is we're going to add a new healthcare position. The sector breakout we're seeing with MDXH suggests that there are more opportunities out there. So I'm going to look at established pharmaceutical companies or maybe even healthcare EITs that offer both defensive characteristics and growth potential. These changes maintain my core thesis around resource and defensive growth while improving diversification and reducing concentration risks. The goal isn't to chase performance, but to optimize the portfolio structure for the next phase of the market cycle. Now let's take a look at 2 stocks that we originally bought and sold. We had Bureau, also known as Nuburo Inc. We bought the stock back on September 17th. We've got about 14 cents, 0.48, and we got 1,000 shares. Then we sold 250 shares, which is 25% for 24 cents. And then we sold another 250 shares at 26.55. And then we decided that we were going to sell the complete stock holdings because we noticed that there is slight fluctuation in the chart. Now, this last sale happened on October 2nd, and on October 2nd, we were right here. Now, look what happened. It jumped to 31 cents, and then now we're back at 21 cents. So we made the right call by selling everything for about 26.73. Now, we could have waited until we hit the top, but we don't know when that's going to happen. And the signals were telling us to sell our position because it was too risky. So now we can go back in and buy into Nuburo once it calms down. And as you can see, it's been on a downwards trajectory. So let's make sure we keep an eye on it. The next position that we also bought and sold was QBTS, which is the quantum play. We bought 25 shares at around $14.9 USD. It went up, and we sold 5 shares at 26 USD. And then we sold 5 shares at 28.25 USD. We had a stop limit sell order at $24, which is what we didn't sell. We sold before at 26 here and at 28 here. And our stop sell order was at 24, which is $9 per share higher than what we bought it for. Now this triggered and sold automatically because the market was positioning itself towards the downward trend. Now in this case, it actually continued back up and went up to 32.70. So we could have held this position, but the stop sell limit order can't differentiate between something that is a minor correction or a long-term correction, and you don't know at that point in time. So this is one of those examples where sometimes your sell orders trigger and you win, and sometimes you don't. But you got to look at the risk factor. Is the risk worth the reward? And in this case, I think we still made the right move. Another stock that we bought and the stop sell order triggered was SMR. Now, we really like this play, but there was a little bit of volatility in there. We bought 6 shares at 35.60 USD, and then our stop sell order triggered at $36. But then it went back up, and now it's sitting at almost $40. So here's when it sold, and now it's back over here. So not too worried. It was a safer bet in case this stock was tumbling down. There you have it. We've shown you exactly what this portfolio was doing and how well it was doing. The good, the bad, and exactly what I'm changing. If you found this transparency valuable, smash the like button and subscribe with notifications on. I'm going to be doing these portfolio reviews monthly, and you'll get to see how the changes play out in real time. Comment below what's your biggest holding, and do you think that we're making the right moves with this portfolio? I read every comment and often reply with additional insight. Thank you for watching the channel, and remember, this is actual money and actual decisions, not paper trading or hypothetical positions. Your situation might be completely different, so always do your own research and consider your risk tolerance. Thank you for joining this honest portfolio review. We're going to come back next week with more penny stocks and other sectors that we think are going to be valuable. As you can see, some of the stocks we put on the channel we actually bought. But you can't buy every stock you see. We can show you that they're available, and we are holding some cash position in this account in case we see something crazy that we think is going to pop off. So you always want to have a cash position. Thank you for watching till the end of the video. I hope you learned something. And if you can, please share this with other people who want to see what it looks like. Mainly beginners and people who are not sure how these trades are going to work for them. Until next time, stay diversified, stay safe, and I'll catch you in the next video.